So this video is the first in a brand new series covering methods to manage safe withdrawal during retirement, or when you move into withdrawing against your assets. In this video, we're starting with the granddaddy of all withdrawal methods. That's the 4% rule. Now you've probably heard of the 4% rule, but there's a lot more to it than meets the eye. A lot of people think it's just about taking 4% from your portfolio on a yearly basis in retirement, but that's not quite right. Plus, I'll cover how well the 4% rule has survived through the ups and the downs of markets through some of the most difficult times since the rule was developed by William Bengen, and what you can do to improve both the amount you withdraw, but also how to make those withdrawals safer. And if you enjoy the content of this video, then please like and share. The 4% rule came about from a landmark paper published in 1994 by financial advisor William Bengen, or Bill Bengen. He was looking for a way to help retirees figure out how much they could safely withdraw for their investments without running out of money. Essentially, the guidelines suggest retirees can safely withdraw 4% of their retirement savings in their first year of retirement and then adjust that amount for inflation each year following. The remaining retirement savings should theoretically last for at least 30 years. To reach his conclusions, Bengen made some key assumptions and considered some key constraints. He based his research looking at the US historical stock market data from 1926 to 1995, and during this time frame he was looking at rolling 30-year periods. Portfolio mix, he assumed a portfolio of 50% stocks using the S&P 500 as a proxy and 50% bonds, intermediate term US government bonds. Another assumption was that money was invested in tax-deferred accounts like IRA or 401ks. The equivalent in the UK would be an ISA. The assumption was that the withdrawals were made within the first year of retirement at 4% and adjusted upwards each year to keep pace with inflation. It's crucial to understand that the 4% rule doesn't consider factors like fees, investment fees, management fees or trading costs could eat into returns, and the impact could considerably alter the withdrawal rate. Taxes, if your retirement funds are in taxable accounts, you'll need to factor in the impact of taxes in your withdrawals. Unforeseen expenses, major life events like healthcare costs or supporting family members could force you to deviate from the rule. And finally, variable spending. The rule assumes a steady inflation adjusted withdrawal each year, where your actual spending might fluctuate. The 4% rule has faced its fair share of criticism. Market conditions, critics argue that today's low interest rates and high stock market valuations could make the 4% rule too optimistic. There's also questions about its global applicability. Studies show that the 4% rule might not be sustainable in other countries with different market histories and economic conditions. Another criticism raised to the 4% rule is that the fixed withdrawal rate might be too rigid, and the more dynamic approach that adjusts to market conditions might be better suited. I just want to draw out a couple of examples of how the 4% rule works in practice. In this example, we start with £500,000 in year one, multiply that by 4%, which is our initial year's withdrawal according to the Bengen study, and that gives us withdrawal amount of £20,000. We then take this £20,000 and put that into year two. And that's the starting point for our second year's withdrawal calculation. What we then do is multiply by inflation in year two, and that gives us then £20,500. We then do exactly the same again for year three. We take £20,500, put that into year's three starting point, multiply that by inflation, year two. What that gives us then is the withdrawal amount for year three, which comes to £21,013. And the beauty about the simplicity of this method, it can also be used to work out the assets you need to be able to support a certain amount of withdrawals every year. Let's say that the withdrawal amount that we need in the first year is £20,000. If we multiply this by 25, then what we get is the assets required to be able to support that withdrawal within year one. And then, of course, subsequent to that, supporting the inflation increased withdrawal amounts on a yearly basis. Despite the criticisms, the 4% rule has held up remarkably well since its inception, even during market downturns like the tech bubble burst in 2000 and the financial crisis in 2008. Retirees who started using the 4% rule around these periods were still able to make their money last. However, it's worth noting that prolonged periods of high inflation could pose a challenge to the rule's sustainability, as this can significantly erode the purchasing power of your withdrawals. So how can we improve on the 4% rule? Well, Bengen himself has revised the 4% rule over the years. He's acknowledged that certain factors can improve its effectiveness. Diversification, adding asset classes like small cap stocks, international stocks, real estate or gold can potentially boost returns and increase the safe withdrawal rate. Holding assets in tax-advantaged accounts can help preserve more of your withdrawals. Rebalancing regularly across your portfolio can help you maintain your target asset allocation and manage risk. And of course, remaining flexible, being willing to adjust your spending in response to market downturns or unexpected expenses can help your portfolio last longer. Bengen's also indicated that in low inflation environments, a withdrawal rate of 5.25 to 5.5 might be feasible with more diversified portfolios. However, he still stresses the importance of starting conservatively and adjusting based on market conditions. One important factor and a common misconception is around how you apply the inflation rate. Remember, the 4% rule is inflation applied to the withdrawal amount, not the principal each year. You take out the previous year's withdrawal amount and add inflation to that in line with inflation every year. Now, I've done a bit of work modeling the 4% rule within AI. I've used Gemini, but also ChatGPT for this. I'll put the prompt into the description of the video. So in this Monte Carlo analysis, I'm using the following criteria. Initial portfolio value of 1 million, annual withdrawal amount, is the initial starting year's annual withdrawal amount of 4%, and that will be then adjusted for inflation each subsequent year by the Monte Carlo analysis. Inflation rate in this case 2.5% with a standard deviation of 2%, 30-year time horizon, and the asset allocation is, as per the Bengen study, 50% stocks, assuming average return of 7.5%, standard deviation of 15%, and 50% bonds with an average return of 5%, standard deviation of 7%. Looking to rebalance on an annual basis around that stock allocation. And you can see the outputs we're looking for: the success rate and the final portfolio values adjusted for inflation, showing us the minimum, maximum, and average portfolio values. So here I am now in Gemini. You can also do this in the free version of ChatGPT. I take that prompt and add at the top, please carry out a Monte Carlo analysis using the following criteria, and put that into Gemini prompt, submit that, and what we get from that is the outcome. Now, it's worth noting again that this is a Monte Carlo analysis, not based on past data like the Bengen study, but you can see from this success rate was 93% over 30 years, talks about the portfolio values and the likelihood of achieving a safe withdrawal over those 30-year periods. You can also use this website that gives you a Monte Carlo analysis simulation also. Often in relation to the 4% rule, the Trinity study is often quoted. Now, we need to remember the difference between the Bengen study and the Trinity study. Bengen study was 1994. It was a deterministic approach, looked at the period between 1926 and 1990. The key findings were the 4% safe withdrawal rate in all historic scenarios. And the impact, well, essentially it was the first to propose the 4% rule. Now, the Trinity study, published in 1998, it was a Monte Carlo analysis that was used. The date period that they looked over the data from, similar, 1926 to 1995. The key findings, again, the 4% safe withdrawal rate had a high probability of success. And the impact of the Trinity study? Well, frankly, it popularized the 4% rule. So there you have it. A relatively deep dive into the 4% rule. It's a valuable tool for retirement planning. It's more of a guideline, but it's not a one-size-fits-all solution. It's essential to understand that you need to put flexibility around this guideline to make sure it's applicable to your circumstances and the nuances of the market as it goes forward. And the next withdrawal strategy I'm going to cover is the bucket strategy. Now, a version of this is what I use for my management of my assets and my withdrawal strategy, but you should see a link for that either here or here coming up in the next couple of days. If you found this video helpful, useful, please give it a thumbs up, like and subscribe, and I'd be really interested in your views on the 4% rule, how you might have adapted it for your own circumstances, and I'd love to see that in the comments if you've got any.